Hey, 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 welcome to Credit Makes Sense with Netiva, the Frugal CrediTnista, where we make sense of your credit, your money, and everything in between. Super excited to be with you today. For those of you who don't know me, again, I am Netiva, the Frugal CrediTnista. I own M&H Financial Services, where we help women and couples over 30 to create custom credit solutions to crush their financial goals. I also am the founder of the BOMB free community, Credit Makes Sense, where we 10x those conversations on credit, money, home buying, and all of that good stuff. And I own the Epic Credit on Fire Academy, where we take conversations on money, credit, debt destruction, and take it to that next level, mastering your money, destroying your debt, sowing your credit scores, and leverage it to begin making wealth creation moves, investing in real estate, stocks, et cetera, et cetera. So left information on how you can rock out with us. If you are seeking additional information on how to move to that next level for just $25 a month, we bring it all to you. Me and my wealth partners who are other business owners in the financial education industry in various sections from real estate investing, wholesaling in real estate, investing in stocks, forex trading, etc., are here to assist you. So let's get started. In Credit Makes Sense, I answer your questions, whether you're in an email community, my free Facebook community. Credit on Fire gets me all the time. So, or viewing me live and want to submit a question, I did leave the email address above for those of you on Facebook, and below for those of you on YouTube on how you can submit your questions. So the first question, and we're actually going to answer two today because they're surrounding student loans. I'll go ahead and pull it up. I like to read it verbatim because if I paraphrase, I'm missing things. So I wanted to make sure I read it directly. Okay, if the repayment, I have student loans that I'm paying on. I have an income-based repayment plan. So my repayments is based on income. Why doesn't my interest reflect this? My interest remains the same. That's a great question. Believe it or not, I have never been asked that question before. But your interest rates on student loans are set. They're set by Congress, and they are not moving anywhere. So it doesn't matter if you have a income-based repayment plan, graduated, another income contingent plan, or income-based like you're on, like it doesn't matter. It's going to remain the same. Whether you're doing the standard 10-year or you signed up for the extended, which I believe is like 20-25 years, your interest rate is exactly how it's going to be, and it's not going to go anywhere. And so usually interest is set, I want to say in the summer. Let me actually look. I brought a cheat sheet that I used to use when I was working in the financial aid office. Yes, and I had a lot of jobs. Yes, okay, it's set for each new school year. It's effective from July 1st to June 30th of the following year. And they actually have caps that Congress sets to make sure the interest rates don't go too high. So it does not matter what your student loan repayment type or program is, those interest rates are set and they don't fluctuate no matter what. The other question on student loans that I received, and I'll pull that one up for you guys. That one is based on student loans and home buying. I got this a lot. Actually, if you are on Facebook or YouTube, you can search my videos. And I know I put links to it on Instagram as well. Where I went through like a whole little mini segment on student loans and home buying. It used to create a lot of skid marks in the road when you were going to, when you have a lot of student loans and you're trying to buy, right? Because they took the 1% of the total amount that you owe and they factor that into your debt to income ratio. So if you had a high car note or a decent amount of debt that you're carrying for credit cards and personal loans, etc., it got kind of hairy when you factored in the mortgage onto that. So basically there's a limit that lenders set of how much debt you can have based on your income level, and if you surpass that, then you were automatically denied your loan. So FHA, the highest they go is 56, it's a little over 56, so let's just say 56% of your income can go towards debts, and that includes the new mortgage. And I think for conventional it's about 50%, and I know lenders vary as far as VA. And a lender can limit that. So you may go to one lender and it's like 46%, another lender is 50, even though FHA, et cetera, goes up to 56. So keep that in mind. So if you have a lot of student loans, you do have options. You mentioned that you have 125,000 and you actually say, yeah, I know that's a lot. I have a doctorate's degree. Oh, go ahead, sister. And your credit scores are 641. What should I do to work on it? Okay, you also mentioned that you have a 1% credit card utilization, but you didn't tell me your overall debts. So, I'm sorry, not 1%, 6%, which is great. Great credit card utilization. I don't know if you have the car and insurance and what your other fixed debts are, but as far as student loans, FHA will not consider your income-based repayment plan. So she's asking if her income-based repayment plan amount will be considered. No, it will not. FHA likes to work with what is the amount that you're paying that's going to amortize or pay off the loan. So they're not going to care about your income-based repayment plan. Now the VA will, depending on the lender. So the VA is less lenient. So I don't know if you're a veteran, you didn't mention that. And conventional. Fannie Mae, which is one of the big powerhouses in Freddie Mac, but Fannie Mae came out with a program last year, I believe it was. And it allowed those who had deferred student loans and who were on income-based repayment plans to also use that amount to factor into their debt into income ratio. For those of you who don't really know what I'm talking about, let's calculate this. So she has $125,000. If she took 1% of that, that means that $1,250 would be factored into her debt to income ratio. Your debt to income ratio looks at your gross monthly income, your fixed monthly debts, and it divides it to see what percentage of your monthly income is going towards your debts. And as I said before, if it's above a certain percentage, you are automatically denied. That's the number one reason why people are denied a home, not their credit actually, but their debt to income ratios. So if you have $1,250 added into your debt to income ratio on top of your already regular fixed expenses, that can knock you completely out of the home buying park. So knowing, so number one, if you're in an income-based repayment plan, having that more affordable payment or even zero be considered is like lovely. So Fannie Mae came out and actually got, because I don't do too many conventional, so I actually asked one of my loan officer partners to fill a sister in on some information, and this is what he sent over. So a low payment on your credit report could just be used. So that means the income-based repayment amount that you have could just be used and not that 1%. As long as there is documentation to prove that your payment is what's stated, either A on your credit report or B on your application, you're good. Even if that amount is zero, it can be used. If the $0 repayment terms expire in a few months, then as long as you have documentation proving that it will be renewed for another year at $0, you can still use that $0. Now, why do most of my clients use FHA? FHA is like crazy lenient on a lot of credit blemishes. What else? Requirements. I mean, they're just super lenient. Conventional is more stricter. So that 640 credit score, I would definitely consider bumping that up as much as possible. I would make sure you pay everything on time. Keep that utilization low. That is super incredible. And congrats on your doctorate's degree. I am super excited about that. But it's definitely doable. I leave a whole course or section inside of my Claim My Keys, the home buying masterclass inside of Credit on Fire. And then my Rent to Home has even more information. That's a full-blown course, 12 weeks that walks you through going from renter to homeowner. If you want to set up a consultation, I left a renter to homeowner consultation in the link above or below, depending on what platform you're looking on. And we can rock out with that. Let me see. Okay, the question is, what about FHA if I know that I need to go FHA based on my credit? Well, they don't care if it's in deferment or not. They don't care if it's in income-based repayment or not, like I mentioned. But they do want to know that the amount that you have paying, or the amount that you're paying per month, is going to pay out the loan. So that means you can go on the extended plan. That's definitely going to cut it. A lot of lenders would suggest that you consolidate because that's going to bring your monthly payment down. By the way, the standard repayment plan is 10 years. So whenever your loans kick back into repayment after you stop school, it's going to be on an amount that pays it off in 10 years. Extended takes that 10 years and stretch it. I want to say 25. It's like 20 to 25, but it stretches it an additional 10 to 15 years so that your payment is smaller. Then you have the graduated program, which starts you off small and then graduates into larger payments. Then you have the income contingent contingent plans, like the income-based repayment plan that I mentioned, the pay-as-you-earn, etc. So those are a little bit different, and you usually have to qualify year after year. So because you have to qualify each year based on your taxes, it's not a permanent type of plan. And like I mentioned, some lenders ask you to consolidate because once you lump all those loans together, then usually your payment is smaller and you stretch it out over, I believe, 20 years or so. But consolidation is not always the best decision. Like I've paid off a boatload of my student loans by not consolidating and snowballing them. I grouped them all by interest rate and then by amount. So like all of my 7.2, 6.8, it's all the way down to like 2.7. So I could just, and I tackled the highest interest rate, lowest one first, and just start paying them off. Oh, and unsub. So if you have no idea what I'm talking about, I do have a challenge inside of Credit on Fire. Usually opens up, I want to say month 2 or 3, because I'll walk you through other things with your money and your credit before you get to that step. And I literally break down what I did and what sub and unsub means as far as your loans, how the interest rates are set and all that good stuff. Because after you've tackled the main debt and, you know, got the credit on point and got a plan in motion, then it's time to go to the student loan. So that's why I schedule it like that, to walk you through it in a step-by-step process. I do have 2 people that I work with if you guys are interested in just student loans and don't want to wait around for the course inside of Credit on Fire, who I recommend even family to. So if you need that, then just use the email address that's below, social@mnhfinancialservices.com, social@mnhfinancialservices.com. The other question was about the VA and student loans. Yeah, I did mention that. Deferred, okay, your deferred student loans and you're a veteran. You know what? I believe the VA is the only one that like will recognize a deferred student loan or the 0 payment while you're in deferment. So they'll count 0 as your student loan payment as long as the deferment is more than 1 year. So you can't be like, oh, I graduated in 4 months. No, they're not going to use that. But if you're still in school and you're not going to get out for like a year, 2, 3, what have you, then they're cool. They'll use it $0. So the VA program is great. It's great. So the other question, let me see. Does FHA have to use the 1%? When I got my house, they use, I think you're trying to say they use the amount that was on your credit report. So with FHA, let me make sure I answer your question correctly. Your student loans have to be counted whether it's in deferment or whether it is in income-based. Okay, like whatever, it has to be counted. So you're saying, oh, okay. So no, they don't have to use the 1%. They can use the amount on your credit report as payments. Or if you get like a letter from, like we have to do this when we purchase, we have to get a letter from our student loan servicer letting them know the amount because the one that's on our credit report was wrong. And they usually use whatever is higher. But if you have that documentation saying this is your permanent payment, it's going to amortize a loan, they're going to use that amount because that's what the payment is. So yeah, as long as you got documentation showing what it is and it's going to fully pay off the loan, they're good. Did it used to be like that? No. So I don't know when you actually bought your home, but this has been an FHA rule for a couple of years now. So yeah, if I didn't answer that right, let me know. Let me know. All right, as I mentioned, thank you so much for joining me on Credit Makes Sense, where we make sense of your money, credit, and everything in between. And if you have any questions for our future segments, definitely shoot me an email at social@mnhfinancialservices.com, social@mnhfinancialservices.com. If you want to attach documentation and we use that, block out all of your information. If you want to remain anonymous, you notice that I mentioned names today, let me know. Otherwise, I'm going to be like, hey, Stephanie. And I would say it, okay? And if you have questions based on this one, definitely post on there. I always go back and run through them because when we're live, sometimes the questions run back late. And I want to make sure that get the education that you need. Share it out. We got to share knowledge. We have to, knowledge is so empowering because once we apply it, it creates transformational lifestyle changes. So share it out to anybody who you feel may share out to everybody. Okay, we never know when to prejudge who needs what information. And like I said, any other questions, post them in the comments. YouTube, Instagram, Facebook, all the platforms, share it out. And if you have any questions, let me know. And if you are looking to 10x your learning, okay, Credit on Fire is the place to be. Mastering our money, destroying our debts, soaring our credit scores, leveraging it to create your wealth. It's $25 a month. And yeah, hope to see you inside the academy. Chat with you guys soon. Bye-bye.